if we see gold on a closing basis break above this resistance line right here, and it's at a pretty strong tack, a 53% angle, we could, and again, this is on an exceedingly long-term basis. I'm not talking about in a couple of days or even a couple of weeks or a month, but this would be towards the third quarter of this year to the end of this year. We could test 5,500. But of course, before we do that, this is the key mark to beat, which is the recent all-time record high above 2,400.
Gold has been on a tear recently, with multiple catalysts pushing prices close to historical highs. Over the past 6 months, the price of gold has risen approximately 20% to more than $2,000 per ounce. CMC Markets recently said a Fed pivot will trigger a sell-off in the US dollar and tank bond yields, sending gold prices up to $2,500 and $2,600 per troy ounce. GaryWagner, the mastermind behind the gold forecast, illuminated the intricacies of the gold market. GaryWagner shares his perspective with a focus on long-term trends, envisioning gold potentially reaching above $5,000 by year's end following a breakout. Yet he underscores the necessity of surpassing the recent all-time high as a critical precursor to this bullish forecast. Between January 1971 and March 2024, gold had an average annual return of 7.98%, which was only slightly behind the return of commodities, with an annual average of 8%. The annual average return of gold in 2023 was 13.1%. In his analysis of gold's price behavior, Wagner delves into pivotal support and resistance markers. He emphasizes that the market must surpass the present resistance line to realize a bullish trend. Gold prices witnessed a proper pullback at the end of April. Still, the bullish sentiment returned this week after Federal Reserve policymakers hinted that rate cuts could be on the horizon. Now, we present the clips of GaryWagner's insights from his recent interview with Kitco News. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
We'll get to a flag formation in a second. In terms of support and resistance areas, support is at 2,300, and that is a representation of this extension. I've got a basic fib extension. We use a fib extension if we're going towards record highs, all-time highs, because if we haven't been there before, that's one of the few ways to calculate it. What I've done is put an extension in that goes back to 2022, when gold is at about 1,800 up to about 2,200, this big rally. Then we look at this correction, which culminated a little bit below 1,900 and start charting from there. So from this point here at about 1,900, the extension that is a 618% extension comes in at 2146, 2216, and then the one-to-one relationship. In other words, if we look at this rally here and compare it to this rally here, that would culminate right here at about 2,300. And that's why we're pegging support at this level. Jeremy, you are correct, because it was former resistance. Support and resistance are part and parcel of the same thing. So currently, this same area is support, and we've got resistance at the 1.236 at 2405. It did exceed that on that run up to the new all-time record high, and then it's come down and found support at about, call it 2,300. And so we want to look at these different areas. We also want to look at the ultimate extension, which is a 1.618. Now, this would be an exceedingly long-term market move, but I'll show you why that's important on the second chart. On this second chart, when we look at it, what we see is that we talked about when we first started the chart, this series, we talked about this compression triangle. If it broke out, it would indicate the market moving higher. In fact, it did. And then we talked about a flag formation right here, and we measured this pole to this pole. This was our extension. And the interesting thing is it came up right around here. It far exceeded that, but I'm kind of seeing another potential flag formation in that we've got our pole here. We've had a sharp decline from these highs right in here. And so if we see gold on a closing basis break above this resistance line right here, and it's at a pretty strong tack, a 53% angle. We could, and again, this is on an exceedingly long-term basis. I'm not talking about in a couple of days or even a couple of weeks or a month, but this would be towards the third quarter of this year to the end of this year. We could test 5,500. But of course, before we do that, this is the key mark to beat, which is the recent all-time record high above 2,400.
Regarding the recent FOMC meeting, GaryWagner delves into the speculation surrounding potential interest rate cuts. He emphasizes the importance of the Federal Reserve's balance sheet adjustments in addressing inflationary pressures. While the Fed continues to withdraw liquidity from the money supply, they've opted to decrease the pace of reduction by $30 billion per month, a decision that Wagner views as noteworthy. Expectations that the Fed will still cut rates later this year would be bullish for gold, as rate cuts could weaken the dollar's value, making gold a cheaper option for foreign buyers to purchase and lowering the opportunity cost of holding gold compared to interest-bearing assets. From a technician's perspective, Wagner explores the significant shifts observed in the gold and silver market, pointing out multiple driving forces behind these movements. He underscores that besides the evident geopolitical concerns, the surge was notably propelled by a delayed response to Friday's jobs report. This analysis resonates with Monday's market action, where the spot price of gold increased by 1%. Investors continued to digest the economic news from the latest jobs report, which fell below expectations. Additionally, they considered the Federal Reserve's decision to maintain interest rates at current levels until further easing of inflation. Let's get back to the interview.
What I found most interesting about today's move in both gold and silver, where we had solid moves to the upside, is at first analysts were looking at this, besides the uptick in geopolitical concern with what's going on with Israel, was a delayed reaction to the jobs report that came out on Friday. In fact, on my weekly show and the weekend review, I talked about that it was perplexing that the jobs report came in the way it did, meaning that it certainly came in well under expectations, and we didn't see a sizable move in gold. In fact, we saw the opposite, and the same with silver. This is silver on Friday. And it didn't quite jive with what we should see. In other words, there are certain relationships that we look for, and those relationships get tested every time a new substantial data point comes out, and the jobs report is an exceedingly important one. We didn't get that on Friday, but we certainly got that delayed reaction today. Right. And that, coupled with an uptick in geopolitical concern, is really what moved the market substantially higher in both gold and silver. And realize that during the FOMC meeting that recently occurred, they left interest rates unchanged. B, they talked about that they really need to see something in terms of movement before they consider cutting rates. They might have less rate cuts. Most analysts are penciling in 1 or 2 rate cuts. I still believe that they'll try to squeeze in 2.
Okay.
But that could be an incorrect assumption. The one thing that you want to look at when we look at something like this is how all of these markets work together, and the dollar being absolutely sensitive to statements by the Federal Reserve. And what was most interesting about what we saw was that although they did not cut rates and they left them where they are, they made an important announcement about their liquidation of their asset balance sheet, because the Fed has been pulling money out of the money supply at about 95 million, I believe. It could be billion.
Yeah.
The numbers are so large, they confuse me sometimes. $95 billion per month. And so what they said is that they're going to continue to pull money out of the money supply, liquidating assets from the balance sheet, but they're going to do 30 billion less per month. So they're only going to be contracting the money supply by 65 billion rather than 95 billion. So they're still contracting, but they're leaving an additional 30 billion per month that they weren't leaving in prior to that. And that's an important thing that the Fed has done, because aside from interest rates, that is the other effective tool in their toolbox to deal with inflationary pressures, is balance sheet reduction, QT, or adding to the balance sheet, which is QE.
Goldman Sachs estimates that if the U.S. 5-year credit default swap, CDS, spread widens by 1 standard deviation, gold prices could increase by an additional 14%, reaching $3,080, driven by central banks purchasing a further 6 million troy ounces of gold annually. As we delve deeper into the dynamics of the gold market, what factors do you believe will significantly impact gold prices in the coming months? And how do you plan to position yourself as an investor? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.